Hey traders and investors, it's Serge Berger here. What we can talk about today is implied volatility, and actually, in the sense I'm going to look at it today, bro, it's also pretty much related to realized volatility. It's almost kind of the same thing. So let's look at this quickly. Basically, going back to the early 90s, you see we've had several periods where we sort of had these low volatility bands where the volatility was sort of capped on the upper end or near 2021 on the VIX, and the low end about 10. And that lasted until early 2007. I'm sorry, 1997. Then we had this big volatility burst, and the internet bubble burst from, say, late 97 to early 2000s. Then another low volatility period. Then, of course, the financial crisis where the VIX went as high as 90, but never really meaningfully broke below, say, 15, 16. Very similar to that period in 97 to about 2002. And, of course, the past few years, again, the VIX pretty much capped near 2022, and on the low end went down to 10. So if you look at this chart, it's a very big picture monthly chart. You can see that we've had these low volatility periods followed by volatility periods that have a higher base. And I think we're now slipping back into a period where volatility is going to be a little bit higher. I don't think necessarily the market's going to crash here, but I think as we come into the second half of a secular bull market with maybe another 5-10-ish years left in the secular bull market, we're probably going to have more volatility, mostly because the interest rate environment isn't so much that interest rates are going to spike here so much, I don't think, but just because we're probably done on easing for the most part, right? Doesn't mean they can't keep rates longer for an extended period of time, but just in terms of the general direction, looking out a couple of years, the direction should be at least some tightening, and that's a change in paradigm in the U.S. at least. Of course, in Europe they're still easing, and in Japan that's been a 20-year experience. So that's basically what's going on. I do think there's a call for higher volatility. What that means for traders is it's good news, right? If you can take advantage of that, you can play the options markets, you can be a little bit more active. The trading over the past few years has very much been sort of good for position trading of, say, holding things for a week or two or three, and I think now we're getting to a period where that's still going to work, but you could probably make almost the same returns by holding things just, say, a few days. Just because of the volatility we're probably going to see. The average true range, by the way, in the S&P 500, you can see has gone from a low near 10, which is historically been a very low period, the average true range, and I think this is a 2-week average true range. Near 10 has crept back up to 23, which is looking back to, we haven't seen a 23 handle on this since, let's say, late 2011. So that's pretty meaningful here, and something to watch. And I do think a higher volatility period, not so much in terms of negative, not that it should be very negative for stocks, but just that we can have a higher volatility period here going forward is an important thing to notice. I hope this makes sense, guys. Obviously, if you got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and I'll see you in the next video.